let's start where we stopped last time. Okay, so at the end of my introduction last time, we stopped with this slide, which is announcing a simulation, to make sure you have a good understanding of how an insurance company works and what the business model is. I think it's good to have a very simple, simplified simulation. So I'm going to consider a series of simple assumptions which describe how the insurance business works. Okay? So let's assume that we're launching a company now. So we need a bit of equity, which is the paid-in capital, which we assume 20. Now, what about the amount of premium we are going to collect over years? So let's start that the assumption is that we will start with 100 the first year. And I just indicate that you collect the premium and you cash in the premium at the beginning of the first operating year. So we are going to build a cash flow statement, okay? And column 0 corresponds to the very beginning of the operations and when we cash in all the first premiums, okay? And then we expect that year after year, premium collected will grow by 8%, okay? That's simple. Now, what about the expenses? You have operating expenses due to distribution costs, okay? Particularly, but also other type of operating expenses, admin expenses, okay? And we are assuming that it corresponds to 30% of premiums. All these numbers are basic assumptions, but please believe me, it's quite realistic, okay? I have another assumption here is that I'm assuming that all these operating costs are paid immediately when you collect the premium for the sake of simplicity, but again, it is rather realistic, distribution costs, for instance, commissions paid to insurance agents or brokers, are usually paid immediately when the premiums are received, okay? So when you receive 100 of premium, for instance, for the first year, it means that immediately you will have to cash out to pay 30 to cover the operating expenses. Well, indeed, a bit of money remains after you have paid that. You still have 70 left. Why do you have this left? Because you need money to pay claims later, okay? So what should be the amount of claims? What will be the amount of claims? It is predicted that the expected loss ratio, which is the amount of expected losses over the premium received, will be 72%. It means that when you collect 100 of premium the first year, in your balance sheet, you will take into consideration the fact that you are planning to pay 72 in the future, okay? When in the future? That's an important point for insurers, And again, in this domain, insurers have data. They collect a lot of data and they can make reasonable predictions about when they will have to pay. So here we assume that 50% of the cost of claims will be paid 1 year after premium have been collected, okay? And then 30% the year after, and then the remaining 20% the year following, okay? So in other way, we're assuming here that the insurers will pay in 3 installments the claims which have to be paid. Indeed, this is not quite realistic because in real life, there is a continuous flow of claims payment because, if you have, let's say, 100,000 customers in the motor insurance lines, you have accidents every day and you have claims payments every day. But indeed, here, for the sake of simplicity, we're assuming that there are just 3 payments, one after 1 year, the second one 30% after 2 years, and the third one 20% remaining the year after. Well, as you can see here, the insurer will receive money first and then pay claims later. So in between, you will have a certain amount of money in hand, and this will be invested. And the expected annual return on financial assets will be 5%. Okay? The payout ratio, you know what the payout ratio is? If there is a net income, okay, if there is a profit made, well, half of it, 50%, will be distributed as dividends. Okay? Well, as I indicate here, a useful simplification. The amount of physical asset is so small. Well, actually, what do they need, insurers? They need computers and offices, okay? So let's assume, to make it simple, that offices are rented, everything is rented, so it will be in the operating cost. Why this assumption? To make it simple, to avoid to have to deal with depreciation of equipment and so on. You know, that's not what I'm interested in. And also, I'm assuming that there is no tax, again, for the sake of simplicity, because would you like to have a realistic approach to taxes? Then it's not only an income tax you should have to consider, but different type of taxes depending on the type of investment made by the insurers. So at this point of my presentation, let's forget about tax so that we can simplify to focus on the essential of the business model of insurers. What are the questions? Well, that is something that normally I would ask you to do in class, but indeed, it's a bit tricky here. So we'll try to prepare, we are not going to try actually, we are going to prepare the financial statements, income, cash flow, and balance sheet for the 5 years to come, okay? And then we will analyze the determinants of the net income, okay? Then as we'll see, we're going to assume a zero premium growth rather than 8%. We're going to take 0% just to be able to focus on one important point, which is the importance of the time lag between the moment when you receive premiums and when you pay, okay? And then the last point will be to verify that the dividend policy, the fact that you don't accumulate all the profits within the company, but you distribute part of it, is that compatible with a kind of solvency rule, which would be in this case the rule that the equity premium, the ratio of equity over premium should never be lower than 17%. Okay, so let's start with this. So let's look at central information, which is the claims payment. You know, as we said, we know that 72% of the premium collected are expected to be cash out later on to pay claims, but it's not paid immediately and it's not paid in one installment. You see, we have 3 installments, okay? Year 1, you would pay 50% of the total claims, year 2, 30%, and year 3, 20%, okay? That's a graph of claims payment over time. And you see we have, if you take a simple average delay, you see we can say that on average, the claims payment will take place 1.7 years after premium have been collected, okay, which is the simple average as you can see here. But I just do this to introduce a concept which you are familiar with, which apply to insurance when you look at the liability of insurers. When I say liability, it's the fact that they will have to pay claims if they collect premiums. So this is a kind of liability, okay? So we could also take into consideration the duration. We will need the duration later on when we look at interest rate risk. Because you know that duration, I'm pretty sure that you saw that in other courses. The duration is a concept which is usually developed to look at bonds and the sensitivity of the bond value when you have interest rate movements. Okay, so rather than the average delay, we could also look at the duration of claims. And you see, I'm assuming here that you know how a duration is calculated, assuming a discount rate of 5%. Okay, then you see the claims payment are there. 36 for the first year, if you look at an amount of premium of 100, and then 21.6, 30%, and the remaining 20%, 14.4. But if you consider discounted value, well, and if you look at the discounted value as the weight, then you can calculate another kind of average delay, which is the duration, which is only 167 here. Okay. Well, so now let's do the job, the financial statement. We have the income statement first, then we have the cash flows and the balance sheet. So we start column 0. That is, you remember the principle, you have seen that in when you had your course in corporate finance. I guess you are familiar with cash flow statements. You have column for each year. And if you have a number within a column in a year, well, for instance, 100 means that it is at the end of year 0. In other words, it's right now. The end of year 0 could be seen as being the beginning of year 1. Okay, that is, these you collect immediately when you start 100. And as we said, okay, the operating expenses will be 30% of that. Okay, and the cost of claims, because the loss ratio is 72% of premiums, then the cost of claims will be 72. That is the income statement for year 0. As you can see, we have a net income which is negative, -2, because if you look at all the costs, all expenses, it corresponds to 102, whereas we only have 100 of premiums. Okay, how can it be? Well, you'll see that in the end, the insurers will make profit. Okay, you should observe that in this income statement for year 0, we have no financial income because we start. Okay, so there was nothing was invested before, so there is no financial income year 0. And that's the reason why we have a negative net income, by the way. Okay, so let's look at the cash flow statement. What about the inflows? Premium, okay, are collected immediately, and also we have a capital increase, which is the amount of equity which we inject immediately when we launch the company. So when we start, not only we collect the first premium, but we also invest the 20 of equity, which is taken here as a positive cash flow. Okay, so in total, at the beginning, you cash in 120. Okay, what about the outflows? Year 0, you only have the operating and distribution expenses, 30% of premium. Okay, because we said in our assumption that the operating expenses were paid immediately when you collect premium. So since you have indicated 100 of premiums, year 0 immediately when you start, so you should also assume that you are going to pay 30 out of that. Okay, so the cash flow of the year for the year 0, the immediate cash flow when you start actually is 90. Why? You have 100 of premium, you had 20 of equity which is injected, and you take out 30 which are the first operating expenses, 90. Okay, what about the balance sheet when you start? On the equity and liability side, what do you have? You have the first line, insurance provisions. Why? Because you see, in the income statement, we took the cost of claim, which is 72, because we're assuming that if we collect 100 of premium, then we will have to pay 72 of claims later. Okay, but in the income statement, we take it as a cost in year 0, because for the income statement, the question is not when you are going to pay, okay, but what is the cost following the revenue you have collected, and the cost will be 72. So you have to register 72 in the income statement, okay, as soon as you start. And indeed, since you haven't paid yet, it will be seen as a debt in the future, for the future. So, and this debt corresponds to what we call the insurance provisions. Sometimes we use the word technical provisions. So year 0, you write 72, okay, which is what you will have to pay, or your prediction, because we start, of what you will have to pay in the future, okay? So what is the equity? The equity is 18. Why is it so? Because you brought in 20, that's the initial equity injection, okay? But you also have a negative net income, which is -2, okay? So the equity to start, okay, will be 18 only. So that you have a total liabilities and equity, which is 90. Okay, 72 plus 18, and 90, which corresponds to the amount of cash you have and which will be invested. That's why the assets are all invested assets here. Okay, so that's for the year zero. Now let's move on. Okay, because the year zero is a bit special because you just start. What's going to happen for the following years? So if you look at the income statement, the premium will be what? It grows by 8% year after year, which means that you have 108 the second year and 116.64 the year after. No difficulty there. What about the financial income? You have 450. Where does it come from? 450. Okay, so 8% income here. And then after 450, you have 671. 671, you remember that assets are invested with a 5% return. So year two, you record the financial income generated by the funds which were invested the year before in T-1. So the year before, the amount invested is 134.10, as you can see. So it is 5% of 134.10, which is 671. What about operating expenses? That's very simple. It is 30% of premium. That is 30% of 116.64. What is the cost of claims? How did I get this 83.98? So the cost of claim will just be the 72% of the premium. You have collected 116.64 of premium. You have to anticipate an amount of claims to pay of 72% of that, which is 83.98. Okay? So I think there is no difficulty there for the income statement. Okay? Well, so now what about the cash flow? So first line, funds available beginning of the year. Funds available beginning of the year is the amount which is invested at the end of year one. Okay, 134.10, which we take as the amount of funds available at the beginning of the year. Okay. Then you find the premium, the financial income, which is cash in, okay, which we have counted in year two. Okay, so no problem there. So you have a total inflow of 123.35. Operating and distribution expenses, I don't insist, it is again 34.99, 30% of premium, which are paid immediately. That's why you have it there. Now, what about the claims payment? 60.48, where does it come from? We are year two. Okay. So if you look at the claims payment, if you look at column 1, why do you have 36? Because year one, after 1 year, we pay 50% of the losses of the claims. So since the total cost of claim for the first premium received, 100, was 72, you start by paying 36 of that, 50% of 72. What happened year two? Year two, you have the second installment of the first premium received. The second installment is 30%. So you still have to pay 30% of 72, plus the first installment of the second flow of premiums. That is 50% of 108. Time 72%, because the loss ratio is 72%. You see, in other words, you have 30% of 72, which corresponds to claims payments for the premium received immediately the first 100, okay, plus 50% of 77.76. 77.76 is actually 72%, a loss ratio of 108. Okay, so you see, when you look at the claims payments, you have a kind of combination of payments from different tiers of premium collected. Okay, so what about the dividend payment? We have 117. Why? Because we have 50% of the net income of year T minus 1. See, year T minus 1 in this case is year 1. We had a net income of 234. Okay, so 234, if you take 50% of that, you have 117. Okay, so the total outflow is 96.64, and the cash flow of the year will be 26.70. Okay, what about the balance sheet? What do you have here in the column 2? 137.26. These are the claims to be paid later. So you have to look at what remains to be paid. What remains to be paid is, first of all, 20% of the losses, which corresponds to the first year of activity. When you collect 100, you know that you will have to pay 72 of claims. When you reach year 3, you already have paid 50%, 30%, 20% remains to be paid. So 20% times 72 corresponds to what remains to be paid from the first premium received 100. Then, when you look at year 1, you had a cost of claim of 77.76. Okay, you already have paid 50% of that. What remains to be paid? Another 50%. So you have 50% of this. When it comes to year 2, you have received premium 116.64. You consider that you will have to pay later on 83.98, and you still have paid nothing from that. So you have the full cost of claims of the premiums received year 2. So altogether, it means 137.26. Okay. Now, what is the equity? The equity is just the equity the year before. Okay, 19.17 plus 219. Why? Because 219 will be is what needs to be added, which is the net income, which is added to which was not distributed and which needs to be added to the equity. Okay, so altogether you see that the total liabilities on equity is 160.80, and this will be the new invested asset at the end of year 2. Okay, so what is a bit tricky there, and why I think this exercise is interesting, and I've tried to do my best to explain to you the numbers, but I really recommend when you're back home, in case you have not well understood, to try to by yourself to recalculate all that. And more precisely, you should try to recalculate the whole block for the 5 years, okay, to make sure you have a clear understanding of how it works. So let's make some comment on that now. If you look at the full picture, okay, you see, we start with 20 of equity. So the equity, as you can see, will grow slowly. Why? Because the payout ratio is 50%. So half of the profits are accumulated year after year. Okay. But interestingly, if you look at the invested asset, you see that the insurance company is accumulating money. Okay. We start from 90. Okay. We move after year 5 to 206.62. Why is it so? It is just because, you see, the reason for the increase in invested assets, the major reason is the increase in insurance provisions. You see, why? Because insurers collect premium first and they pay losses later on. So they have a kind of negative working capital. You know, when you collect the money first and when you pay the cost later, well, it means that you accumulate a kind of running fund, which is typically like a negative working capital, as I said. So you see, the business model is there. Okay, and that's why, you know, even if you have a negative net income year 1, -2, because the financial income is not there, you know, the financial income is there to compensate, as we'll see. We are going to insist on that point. So what you need to understand clearly there, it's the accumulation of funds by insurers because of the accumulation of insurance provisions, which results from the delay, the time lag between the moment when premiums are received and the moment when claims are paid. Okay? And you can see that if you look at the structure of the income statement, that the financial income plays a major role in the profitability of the insurance company. Okay? So these are points which we need to investigate a bit. You know, the contribution of financial income to the overall performance of the insurance company. So, considering the importance of provisions, now it's time to let you know that there are different types of provisions, and let's look at this. The first category of provisions, actually, if you look at the real balance sheet, you would find many types of provisions and so on. I'm just describing the main block and what is essential for a clear understanding of the insurance business. So the first group of provision are provisions for premiums. The definition is there, unearned premium provisions, and the provisions for unexpired risk. You know, the problem is if you sign a contract with your insurer, let's say in June, and if your contract is a 1-year contract, when you have to provide a balance sheet for the end of the year, you see your contract is still running. Okay? So part of the risk is reduced to a certain extent because at the end of the year, you still have half a year of risks, so it's less than a full year, okay? But you need to take into account that at the end of the year, you are still committed, okay? So when the contract terminates after the date when the financial statements are due. So let's look at it with the time axis here. Let's assume that you sign a contract at the end of June, year T. When you built your balance sheet, okay, at the end of year T, 31st of December, well, since the contract is still running, because the contractual period is 1 year, it goes until 29th of June T+1, then the question is, what is the value of the remaining risk at the end of year T? Well, you take a simple rule usually saying it's 50-50. There is half of the period still running, so let's take half of the risk, which would be valued in this case at 36. Okay, so that's for the provisions for premiums. You know, at the end of year, you still have some contract running and the risk is not fully over. So you have to take a certain proportion of that. Okay. Well, after that, you have provisions for claims outstanding. Okay, you have an insurance, and let's assume that you have an accident mid-December. Okay, it may take a bit of time before you get your compensation because, you know, the insurer might have to investigate. If your house is destroyed because of a fire, for instance, you need to have investigations to see why it occurred, how much it will cost to repair the house, and so on. So it takes a bit of time because you need experts coming and so on. Well, so the payment will not take place during the year because if the accident has occurred the 15th of December, you know, the insurer will not have time to do all the job and to provide you with the compensation. So the event generating a possible future payment has occurred during the year. However, end of year, it may not have been fully paid. Okay, so if you take the time axis again, you see the insured event The accident occurred in my example here, the 22nd of November, year T, okay? But you have an estimate for the claims payment only, but it will be definitely paid later than end of December. So you have to write a provision, which is the estimate of the claim you will have to pay considering the event which has occurred, okay? So that is what we call provisions for claims outstanding, which correspond in terms of value to estimated consecutive claim payments to occur after end of year. This is the second category, major category of claims, of provisions, which you find in the balance sheet of insurance companies. Okay? So now, to have still a better, more in-depth understanding of business model of insurers, how are insurers making money, basically? That's a question. Let's look more precisely at the net income. So you see, you have here typical net income, as we've seen, but with more detail. We have operating expenses. I take it for year 1, 2, 3, 4, 5, because year 0 is when we start, so it's not relevant for our analysis here. So you see, you have operating expenses minus cost of claims. Okay, so if you look at just the operation, if you put apart the financial activity, remember last time I have explained to you that actually insurers have two types of activities which are rather different. Okay, in terms of expertise, those who are concerned with underwriting, that is selling insurance, assessing the risk and paying claims. Okay, this activity of underwriting is highly technical. On the other side, because of the provisions and the accumulation of funds, insurers are also investors. Then you need another expertise. You have fund managers. These populations are totally different. Okay. Well, so if you isolate the operating activity, you see that in our example, the operating activity is generating an operating loss. Because if you focus on the premium you receive, if you take out operating expenses and cost of claims, you find year after year a negative operating result. So how can it be? I mean, you see, insurers, when they sell insurance, they have a loss out of that. Well, and that's, as I'll show you, it's the case very often. Okay? But does it mean they have no profit in the end? No, indeed. Why? Because they also have this financial activity. They invest. And as you can see, they get a financial income year after year, starting from 430, which is growing year after year because the amount of money, the amount of funds is growing. Okay? And the net income in the end is positive because the financial income is high enough to compensate for the operating losses. Okay. Another way to approach this is to look at the combined ratio, which is a ratio which insurers calculate and publish regularly. You see, the combined ratio is the ratio of the total cost, operating cost, admin plus distribution expenses, the 30% in our case, plus the cost of claims over the premium received. So you see that year after year, you have 102%. 102%, what does it mean? It means that the operating income is negative because the total cost, operating expenses plus cost of claims, is higher than the premium received. If you have a ratio above 100%, it means that the premium collected are not enough to cover all operating expenses. In other words, it corresponds to the situation we have here, which is a negative operating income. Okay, so sometimes it's difficult to understand that why insurers they have a loss when they sell insurance. Okay, even let me tell you, even in the insurance business, there are some people who have difficulties with that. But it's normal. Why? Because by doing so, they collect funds. You remember I told you that in the first session we had together. You know, insurers, they collect funds. They collect precautionary saving. And this precautionary saving is accumulated in their balance sheet under the item insurance provisions. Okay, so it's fair enough. If you manage the saving of people, that actually they receive something out of that. What are they receiving? They are, in the end, when you look at it, paying premiums which are lower than what would be necessary to cover the cost of claims. You see, when the operating income is negative, we could conclude of that, and systematically negative, it means that in our example, okay, policyholders are not paying a premium which cover the full cost of the insurance activity. Okay? In other words, they benefit from a kind of discount. You could see the negative operating income as a kind of discount offered to the insurers, to the policyholders, sorry. Okay? And it is fair enough because the policyholders, they provide saving to the insurance company, and the insurance company can invest and generate net income at the end because of the financial income they get. Okay? A loss from insurance operations can be seen as a reward for policyholders, a premium discount for the precautionary saving they have entrusted insurers. Okay? So that is not always well understood, and very few people are aware of this unless you are really in the business. So let's look at this a bit more. Now, let's come back to the amount of asset under management in the end of the insurers. You know, it comes essentially from insurance provisions. So to have a better understanding of what the amount, where does it come from, the amount of insurance provisions? Why is it, in our case, sorry, I come back. Here, you see, we have 206.62 for the total invested assets. But if you look at insurance provision, it grows and it tends to stabilize around 170. Okay, what does it come from, this number 170? Why is 172.91? Okay, you're 5. Okay, well, to have a better understanding what I assume now, I'm assuming that the growth rate will be 0, okay, rather than 8%. So would I make the same calculation with 0 growth? What are the insurance provisions? We start with 72, then 108, 120, and then it's stabilized at 122.40. Okay? So starting year 2, the insurance provisions are stable at 122.40. And what does it correspond to? You see that actually 122.4 is 1.7 times 72. In other words, it corresponds to the average payment delay time to total claims. Okay? So you see, it shows clearly here that the insurance provisions depend essentially on the payment delay. The later the claims are paid, the more money in the hand of insurers. Okay? And that's why initially I did calculate this delay, because I knew that I would need it for this explanation later. Okay? In other words, that's something you need to keep in mind. The amount in hand, which can be invested by the insurers, the insurance provisions, okay, the insurance funds, we say sometimes, okay, depends essentially not only on the amount of premiums received, but also on the time lag between the moment when premiums are collected and when claims are paid. The longer this one, the higher the amount of money in hands. And depending on the insurance lines, it's totally different. You know, there are some lines of insurance for which claims payments are done rapidly. Okay, there are other areas where the delay is much longer. For instance, in liability insurance. Okay, well, it may take years before the claims are paid. Why is it so? Because in liability, where lawyers have to decide who is liable, how much victims should receive, and so on, and that takes time. In other words, it's not that insurers don't want to pay quickly. It's just that they cannot pay unless a decision has been made concerning how much they should pay, whether they should pay at all, and who should receive money. Okay, and this may take time. So in this case, that's why in liability insurance, you have a very long delay, and that may indeed generate a certain amount of funds as insurance provisions because of this delay. But I'll see later on, long delays in liability insurance is not always welcome for insurers. That's another point we are going to see for other reasons. Okay, so the time lag between the collection of premiums and the payment of claims is a major determinant of the amount of funds available for investment. Okay, that's an important point also you need to have in mind to understand why insurers are major institutional investors. That's the reason why they have huge amount of funds in hand. And I told you, I think if you keep the image that insurers are collecting precautionary saving, you understand this well. Okay, they collect premiums from a group of policyholders. Okay, and these premiums, they keep it and they give it back to the policyholders when they pay claim. And in between, this kind of saving is managed by them. They invest it and they generate a financial income. And this financial income, in the end, is shared between policyholders and insurers. So now let's look at the solvency ratio. This was the last question in the text of this simulation. The required equity, well, here, the solvency ratio, as we'll see, is a bit more complex than this, but this is the rule which I'm assuming here is your rule that still exists in many countries, and which is rather simple. We'll see today that there are more complex rules through the new regulations, solvency regulations. Okay, we'll see that later at the end of this course. But let's assume to start with that there is a required equity, a kind of capital adequacy rule, which says that the equity should never be below 70% of total premiums. So if you look at the required 17%, and if we take our simulation, what is the value? Well, the actual ratio is 18% to start with, okay, and then it moves down to 17.8%, but still high enough. And then you see year after year, it is slowly growing. So you can assume that the level of equity and the payout, apparently the payout ratio of 50% is acceptable. Okay? Yes, but you know, this is a simulation after all, and we are looking at the future with the idea that the loss ratio will be 72%. What if predictions are wrong? And what if, for instance, the loss ratio is above expectations at 75%? With the same calculation, you would see that rapidly, I mean, the equity is not enough, and the ratio of equity to premium will decrease regularly and be systematically below the required rate. Okay, so you see, the solvency of the company and its financial, let's say, sustainability is very much linked to the capacity of the company to anticipate the amount of claims to be paid. Okay, that's why insurance is really a tricky business. It's tricky because, you know, you collect premium to build a fund to pay claims later on, but you don't know exactly what the claims payment will be. Okay, so the real tricky business in insurance is to price, to make sure that you collect enough to avoid a liquidity crisis and to avoid a situation where your level of equity, your capital requirement would not be met anymore. Hence, the need to price the risk carefully. And this will be the next step in our analysis to try to see how prices are fixed, really, how tricky it is, and how the insurers can, let's say, handle this pricing risk. Okay? So now, before I move to this pricing approach, well, let's look at some numbers so that you can see that what I have assumed is not totally wrong. On this, it comes from a report which I recommend, which comes from Sigma, and you see you have the website here. I think I will send it to you because this report is very important. It's a good reading, which I will recommend for you after. But it's taken from this report from Sigma. Sigma is published regularly by a large company called Swiss Re. I already mentioned it, which is one of the biggest reinsurance company, and it's an analysis of the profitability in non-life insurance. Okay, so it's totally in line with our topic today. So you have different countries here, mature countries, US, UK, Japan, Germany, France, and Canada. Okay, and you see the combined ratio. Remember the combined ratio, we've just seen it. It is the ratio of total expenses, claims, as well as operating expenses over premiums. If it is above 100, it means that companies have a loss, operating loss. What can you see here? In most countries, and Japan is a bit different, is very often below, okay? In most countries, over the period 75 to 2015 in particular, well, you see that we have combined ratio which is above 100%, meaning that all these companies in this country were having an operating loss. Why is it lower in Japan, for instance? Well, there are two reasons for that. The first is competition is not that tough in Japan as far as the insurance activity is concerned. It was typically true before the 90s. Okay, so if competition is not severe, well, as you know, large companies have a pricing power, and they can charge high prices because of a lack of competition. So in this case, insurers can make money, much more profit, and it explains why they can even end up with a combined ratio which is below 100%. That is, they also have an operating profit. Okay. Another reason is that you can have an operating loss if the financial income is high enough to compensate for the operating loss. What if interest rates are very low? What if the invested asset provide a low return? The lower the return on asset, indeed, the less you have to give back to policyholders. Okay, so in periods when interest rates are very low and when return on assets are rather low, and it is the case today, for instance, because unless you take risks, you cannot expect a high return on your invested asset. So in these circumstances, indeed, you can imagine that the combined ratio will tend to decrease. Okay, in other words, you may have to increase your premium to compensate for low financial income. Okay, and this is also the case in Japan. Not only competition was low, but also interest rates were also very low. Now, this graph stopped in 2015. If we look at more recent period with very low interest rates, you can imagine that now combined ratio tends to be lower than they used to be in the past. But if you just look at this, you can observe that very frequently for many countries, well, the combined ratio is above 100%, meaning that companies have an operating loss. Now, if you look at the case of the US, as well as Canada, all these countries, it's taken from the same report. You look at the underwriting result, average for all this period, 2008 to 2017, you see that in most countries except Canada, plus 0.1%, Australia and China is a bit special, okay? You see that we often have negative underwriting result also, okay? Which is compensated by a net investment result, which is high enough to end up with a high return on equity. You see, if you focus on that, you observe some negative point. You have it in the US, you have it in the UK, you have it in Germany, okay, in Italy, in Japan, here this year in Japan. So, you know, these are averages. Australia is a specific case with 3.8, and you can see that there is a very high return, which means that the reason probably is that in Australia the market is highly concentrated, with the possibility for Australian company to charge high premiums. Okay. So here you have a graph which kind of provides a synthesis of what we've said concerning the origin of the return on equity for shareholders. Okay. You have an underwriting result. As you can see in the block, this underwriting result is negative. Okay. It comes from the loss ratio, expense ratio, policyholder dividend ratio. There are some payments to policyholders which are made. So altogether, you find a kind of negative underwriting result. That can be compensated by an investment result, which is highly positive. Okay, all that is made with a kind of average of all these countries which are mentioned here. Okay, and then you have a return on equity, which depends on what? On the operating profit margin, which is negative here. Okay, but also the investment result, which is positive, which compensates so that you have positive profit margins. Okay, and this positive profit margins is boosted by the solvency ratio, which is an indication of the amount of equity. Okay, so if you have less equity, you have a kind of leverage effect. Okay, we'll see that more precisely later on, but you need to take into account the debt equity ratio to analyze the return on equity. And the debt, we are not referring here to the debt equity ratio, but the solvency ratio, which include the proportion of equity in the balance sheet. Okay, so in other words, you have negative underwriting results, usually compensated by a positive investment result, and the ROE in the end is impacted by the level of equity in the balance sheet. The lowest the level of equity, the higher the financial leverage, and the higher the return on equity. So this describes rather well, on average, the non-life insurance business and how profit is made. Negative underwriting results usually compensated by positive investment results due to the huge amount of funds which managers can manage and invest. Okay, so I have finished with this simulation, and I hope that at the end of this you have understood the basics of the insurance business. Now we are going to move, as I said, to a sensitive point, actually, which is the insurance pricing. Okay, essentials of pricing technique, because if you remember well, we had an assumption of 72% for the loss ratio in our example, but would it be 75% instead? That is just 3% more. Well, you see that the company would have a deficit rather than a profit, and year after year the equity would go down, and the system would not be sustainable, which means that basically the insurance company to survive should increase the premium. So here you understand clearly that it is tricky to price, and the pricing is key in the insurance business, non-life in particular. So before we go into a description of the technique, we need to raise a question: what is insurable and what is not? there are some technical requirements for a risk to be insured. Okay, otherwise, you know, if insurers have no element, technical element, and reliable, tangible elements to end up with a price, well, it's difficult to provide insurance, because I remind you that as soon as insurers are taking a risk, they have to value this risk to put it as a liability, as a cost of claims. The liability is the estimated cost of claims. And they have to put it in their balance sheet, okay, to indicate how risky they are and what are their liabilities. Indeed, so you cannot do that if you have no tangible information about the risk. So there are some conditions for insurability. First of all, first point, judicially, an insurance contract can be valid only if the claim occurrence satisfies some randomness property. Okay. A good example of that, I told you already. If you drive your car and you get a fine, that's a risk for yourself. But you know, you cannot insure this risk because it would be it wouldn't be legally acceptable, first of all, and also, why should you drive carefully if you don't fear to have to pay a fine because the insurer will pay for it? You know, the randomness condition would not be fulfilled here because an accident or a bad way of driving would be your responsibility. It wouldn't be a random event. Okay. So, and that behind that, you have the issue of moral hazard. Indeed, you have to make sure that insurance will not generate attitude that would be conducive to a higher probability of risk. Okay, so this is a concept of legal insurability. You have to make sure that the occurrence of the event does not depend on the decision of the policyholder. The possible maximum loss should not be huge with respect to insurance solvency. Indeed, the insurer cannot accept to take a risk that might lead to full costs that would be above its capacity to pay. We'll see that this can be arranged with reinsurance. But even with reinsurance, there are limits, as we'll see. There is a good example, which is the case of a nuclear plant. Okay, as you know, in France, we have a lot of it. Okay, nuclear plant would not exist, okay, unless the state provides part of the coverage. An insurance company could not, considering the size of the consequences in case of severe accident, it means that even the system, the insurance system as a whole, is not able to cope with that. That's why you have a state intervention. Above a certain threshold, if the losses would go above this threshold, then it would become a social issue. I mean, solidarity would play, organized through the state. Okay? So there are some maximum level that cannot be considered. So a risk is not insurable if the losses are above this threshold. The average cost should be identifiable and quantifiable. Well, as we'll see, well, if you have a large population, okay, you want to cover, to provide insurance for it, for instance, motor insurance. You have a large number of people you can insure, and you have data about the cost of claims and the frequency of claims. So you can estimate, you have a kind of estimate of how much it would cost. And then this average cost can be taken as a basis for let's say, the estimation of the premium, as we'll see, because the law of large numbers would apply, and it would make sense to look at the average. It's not always the case. Today, for instance, there is a major risk that insurers are trying to price and they have difficulties, which is the cyber risk. Why? Because we don't have much data about it. And it's very difficult to assess both the frequency and also the severity of this. Okay? So there are some risks for which it's not easy. And if really there is nothing that can be considered to end up with an estimate of the average cost, well, insurers have difficulty to intervene. They would try to do their best in any case, but it's really, they need this type of data to price properly a risk. Risk could be pooled so that the law of large numbers can be used. This is what we'll see later on more with more detail. They need to find a large population with the same risk so that they can use the average for this population. Okay, and the population has to be large enough so that the law of large numbers apply. And indeed, within the population, the risks have to be independent. There shouldn't have any correlation between these risks. That's why, for instance, if you insure your house for fire or whatever, the insurer might provide an insurance for that, but the case of war would be excluded. Why? Because we know that if there is a war, all the houses in a region might be destroyed at the same time. So it's no longer independent. Because of war, for instance, altogether, I mean, all the houses might be destroyed at the same time. Okay, and then the insurer cannot pay for that, you know? The law of large numbers would not apply in this case. Okay, so in any type of contract, the situation of war is always excluded in the scope of the policy. Well, these are points which we called, which refers to what we call actuarial insurability. Actuarial stands for, refers to the technique of using data and averages and using the law of large numbers and so on. Now, there are some other elements to take into consideration. There should be no moral hazard. I already mentioned that for point one. Okay, moral hazard, as I said, you have to make sure that insurance will not have an impact on the attitude of policyholders. If, because they have insurance, policyholders are less risk averse, and if they take risk, if they make the risk more severe, that's a problem. Okay. And they should have no adverse selection. Normally, you should be familiar with the concept of adverse selection because you have it in banking also. Adverse selection is meant when you are in a situation where you end up with all the bad customers and the good ones are not coming to you. Bankers, they have it. For credit risk, for instance, okay, they know that some people might borrow money and not have the intention to pay back the money. Okay, well, against this, bankers might increase the interest rate so that they collect a bit more money, and this additional money would be used to cover the losses due to those who are not repaying their debt. Okay, but by doing so, you see, it's unfair for those who are good borrowers. Okay. And the good borrowers might decide not to borrow money because it's too expensive. In this case, you know, the banks would end up essentially with bad borrowers, and the risk of not getting the money back would increase. Okay, so if you end up only with the bad guys, this is typically what we call an adverse selection. Okay, and that's why banks, for instance, are trying to scrutinize, to use all type of information, and now they have more and more of it through all the social media, to try to identify who are good borrowers and who are bad guys. Insurers, indeed, are doing the same, because when they fix a premium for a population who are assumed to have a similar risk, paying the same premiums, well, still they know that within the population there are bad guys and good guys. So they are also trying, like the bankers, to identify the bad ones to avoid adverse selection. Well, there must exist an insurance market. That is, the supply and the offer should meet and an equilibrium price should arise. Well, the idea here is that sometimes you may find a way to provide insurance, but it is so risky and the premium asked should be so high that the market would not exist. In other words, that the price that the insurer would propose would not fit with what potential policyholders would accept to pay. To a certain extent, it's a bit what we see today with the so-called cyber risk, which I have mentioned already. Okay, insurers can provide cover, but they tend to ask very huge premiums, you know, considering the type of risk and how ambiguous it is to price this risk. Okay, and because of this very high risk premium, well, few companies are ready to pay the price. Okay, so this element refers to what we call economic insurability. So here you have the list of, let's say, conditions for a risk to be insured, for insurance to provide a solution to policyholders, to buyers of insurance. Again, if you want to know more about it, it's not a recent paper, but this paper is a rather good summary of this insurability concept. Well, so having said that, now let's get into the technique. You remember, insurance companies, they need numbers, they need to be able to calculate an average, okay, and the law of large numbers should apply. So let's investigate a bit further into this technical aspects of insurance. So here we are going to do a bit of math and stat, but I know that you had a good course with Professor Chan, and you are all now specialists in statistics, so you would be very familiar with the basic concept I will introduce here. I'm not going much further than correlation, covariance, and standard deviation and means. So normally, you should be familiar with that, okay? So let's assume that we are willing to price a risk for which you have a certain population. They're all, each person is exposed to the same risk. And the size of the population is n. You have n individual risk, okay? They are all similar and independent. Independent means there is no correlation. There is no, if within the population one person has an accident, it will have no effect or impact on the others. It's totally independent. The mean is mu. For instance, let's assume that mu is 1,000. It means that for each person, on average, the expected loss would be 1,000. And there is standard deviation for that, which is sigma. For each risk unit, the loss is a random element, indeed. And x1, for instance, would be the loss incurred for the entity number 1. And x2, xi add to xn because we have n individual risk in the population. Okay? So having said that, the total loss, capital X, is the sum of all the xi from I equal 1 to n. Okay? And the average loss per policyholder will be x over n, which is the sum of all the xi over n. No difficulty there. I have just divided by n each part of the first equality. Now, indeed, this, since all the x1, x2, and so on are a random element, what I will look at is the expected value of the average loss. Okay, and the expected value, E of x over n, is the sum of all the individual expected losses over n. But since all risks are similar with a mean mu, x, the expected value of xi is mu. So you see that the expected value of capital X over n, okay, will be equal to mu. Okay? Because what you have here in between would be n mu over n, which is mu. So now introducing a new parameter, NC, which would correspond to what I call the expected number of claims. Within the population of risk, we have n entities, n individual risk. Not all of them will have an accident. Okay? They will not have a claim payment for each. Some xi will be 0, and a certain number of cases will occur, and there is a certain number of claims to be paid to part of the population. And the number of entities with the occurrence of an event is NC. So I will rewrite the expected average loss by introducing NC. You see, I multiply by NC in the first place, and I divide by NC also the other part. Why adding this complexity? Just to introduce two concepts which insurers are using. The concept of frequency. You see that NC over N is the proportion of occurrence over the total population, the proportion of the expected number of claims over the number of risk insured, which is what we call the frequency. If, for instance, you find 2%, it means that if you have a population of 1,000 risk, well, 2%, which means 20 of them, you will have 20 cases for which you will have a payment to make. Okay? So I think this concept of frequency is clear. What about the other block? The other block is actually what we call the severity. It is the expected cost of a claim, because you divide the total expected loss over the number of claims. Okay, so it is a severity, it is the expected loss of a claim. So we know the frequency. In other words, you can translate this into the expected loss is the frequency times the severity. And it is important for insurers because when they collect data, when they investigate into historical data, well, what they would consider is, well, how many claims do we have to pay? What is the frequency of occurrence of this event? And when it occurs, well, how much would it cost? And then they would differentiate, looking at frequency on one side and severity on the other side for their prediction in the future. They will say, for instance, can we expect the frequency to go up or down? Okay. For instance, if you look at the motor insurance, if you have an improvement of the traffic conditions with bridges rather than crossings, with red lights and so on, with new rules imposed to the drivers, well, for safety reasons, well, you can be assumed that frequency will decrease in comparison with what it used to be because of these new safety rules or a higher level of safety with the cars, with the equipment, for instance. A larger number of people with new cars. Then you can anticipate that the frequency will be reduced. Okay? Well, when it comes to severity, you will say, well, if now cars are driving, they're imposed a lower speed to drive on the expressway, or if you have safety equipments now in the cars which are highly efficient, well, maybe you can expect that the severity would also decrease. So, it's these two concepts are dealt with separately and analyzed separately to anticipate for the future. That's why it is important to introduce these at this level of the analysis. Okay, so that's for the first part. We have an estimate of the expected loss. Okay, and then the problem is, can we take this expected loss as a good reference to price? Well, it is only an expected loss, which means that that in the end, what you may have to pay per policy might be lower than this, lucky you, but it might also be higher. And that's a concern for insurers. That's why now we need to look at the variance, at the volatility around this estimate of the expected loss. Okay? So here I'm assuming that you know how to calculate the variance of X over N, knowing that capital X is the sum of all individual losses. I'm not demonstrating it, and normally you know that, but if you don't remember, please believe me, that will be the expression for the variance of X over N, which will give us an idea about the volatility around the expected loss. Okay? So let's look at this formula a bit more. I'm going again to transform it this way. What I've done here is not too difficult. I have detached part of the sum, double sum. I have detached all the cases when I and J were different. Okay, and the first block is when you have twice I, okay, and therefore in this case the covariance of xi is obviously the variance of I. Okay, so the first block is the sum of all the variances over n squared, okay, plus the double sum for I different of j of all the covariance over n squared. Why should I do so? Because now I will introduce the assumption we have made in the first place. If you look at the second line here, we said that all the risks are independent. Okay? If all the risks are independent, what can I conclude? I can conclude that all the covariances with I and j different are zero. In other words, the second block of my formula, which is above, is zero because all the covariants are null. Now, if I look at the block with variances, we have assumed that all the risks were similar. In other words, sigma I is the same whatever the individual considered. Okay, so we have sigma I equals sigma for each value of I. In other words, we end up with a variance of x over n, which is just the variance of the risk over n. Okay, so if we have this, because sigma of all the variance, it means it n's times the sigma, and since it is over n squared, you end up with this formula: the variance of capital X over n, the variance of the expected loss is just the variance of one unit over n. So why is this? And here you see, probably you are familiar with this formula, which is actually the central formula to understand the law of large numbers. Large numbers is a case when n is very large. So if n is very large, you see that the variance of the expected loss is very low. The standard deviation of the distribution of the average loss per policyholder decreases when the size of the population increases. If you increase n, the expected loss is indeed going down. Okay, and if you have a very large number, it tends towards zero. Okay, so that the mean may become a reliable estimate. Okay? If you have a large number, and if all the risks are independent, really, okay, then you can count on the expected loss as a good reference for your pricing, with not much risk because there is little risk to go far away from your expected loss. Okay, this is the principle of law of large numbers, and this is what I would call the ideal situation for non-life insurers when they come to pricing. Okay, that is a perfect case. You know, indeed, as we'll see, real life is a bit different. Why? Because we don't have always historical data to have an estimate about. We have assumed here that we knew the individual expected loss as well as standard deviation, well, which is not always the case. We have assumed independency with covariance equal to zero. It's not always the case also. Okay, so indeed, real life is a bit more complex, but basically this is the basis of the insurance pricing techniques. And we'll see we'll see how it works. So let's take an example here to illustrate what we have said before we move to situations which are a bit trickier, for which the variance may not systematically shrink to zero. So just to illustrate the what we have done before, let's assume that we have a risk which would be represented by this probability distribution. Either you have a total loss of 50,000 euros, and the probability of that would be 10%, or you have no loss with a probability of 90%. This is the description of the unit risk. So as you can see, the mean is 5,000, 10% of 50,000, okay? And the standard deviation, I'm assuming here that you know how to calculate it, but believe me, here we have 15,000, okay? Well, now, if I use the formula we had before, okay, Or if I try more precisely to, with an Excel table, you can do it and so on, generate the probability distribution of x over n, you know, you have a n 50 in this case, and the distribution of x over n would be like this. And you, as you can see, it looks like a normal distribution with a mean which is at 5,000. Okay. Actually, the curves move until the extreme right of the graph, up to 50,000, because the probability that all individuals within the group have a loss cannot be excluded. It may happen. Indeed, the probability of that is very, very unlikely. Okay, that's why insurers, they will have to make the assumption that it will never happen. Okay, and they will center their analysis on this type of curve, which looks like actually a normal curve. So you see, that's also a property of the law of large numbers. Not only the variance of x over n tend to decrease, when you increase the size of the population, but you tend towards a normal distribution for the expected loss. Okay? If you increase the size, if you take n equal 100, you will have a smaller variance, and you see you will have a curve which would be more like this. So the higher, the higher the size population, the lower standard deviation, and the curve will become narrower and narrower. In other words, it shows that the probability to get away from the expected value is decreasing with the size of the population. Okay? But one last remark before we move to the next step. That is, you see, insurers, they are kind of playing a game because they are assuming that it's very unlikely to have the occurrence of a large number of risk. But they assume it. They say, well, we'll be lucky enough, it will not happen because the probability is so low. Okay? But who knows? Okay, it may happen one day. After all, it's not totally impossible. Okay, this is what sometimes we call subjective certainty. You are not sure, but subjectively you will assume that it will never happen because it is so unlikely. So the insurers are in this position. Okay, well, so now we're going to go a bit further into the pricing and insurance based on this law of large numbers. We'll see how we can end up with a price, assuming nevertheless the fact that the variance is always moving to zero, just because sometimes the size of the population is not large enough, or for other type of reason linked to the uncertainty concerning the data you have. Okay, but the law of large numbers is really the basic principle that insurers will refer to for their pricing technique. Okay, so we are going to go now more precisely into this pricing technique. But I'm just looking at my watch, and I just realized that it's 9:30, and I think it's 9:30 for me, which means that it might be 3:30 for you. I think it's the right time for a coffee break. I don't know what you think about it. I'm pretty sure you would agree with me. Okay. Let me just okay. I'm pretty sure you will be okay with me. Let's have 15 minutes. Okay. So see you in 15 minutes. See you. vois, il est là. Il est là ton sac à main, Mimi. Le sac à main est là. Okay, guys, I'm back. Are you ready? Okay, so now insurance pricing. So let's get into more details now, because there is one point that needs to be considered, which I have not considered so far in my quantitative presentation about the law of large numbers and variance and so on. It's time. Because you remember, it is a very important element to take into consideration. The time lag, the delay between the moment when premiums are collected and when claims are paid. Okay, so now we need to integrate this dimension to have a clear understanding of how the pricing is made. So I'm now going to introduce a distinction between total premiums and what we call the pure premium. So PT0, 0 stands for the time, the present time, the immediate time. So PT0 represents the total amount of premiums collected for a generation of policies. So what is a generation of policies? We assume that we have a certain population with the same risk, and for this population, we are going to sell an insurance policy exactly the same at the same date for the same period of time. Okay, so a generation of policy, to summarize, is as written here, a set of similar policies underwritten at the same date for the same period of time on an homogeneous population exposed to the same class of risk. In other words, we had, if we come back to the example we had before, we have a size n, a population made of n individuals. They all have the same risk. We know the expected loss. We know the standard deviation. They buy a policy at the same date for the same period of time. Okay? Now, I'm going to introduce what we call the pure premium, which is P0. It is a net amount available for claims payment. In other words, what I'm saying that you collect a total amount of premium PT0, but part of this will be used to cover admin expenses, distribution costs, and the like. In other words, you have a part of the premium which is used to cover the cost of running the insurance business. Okay, so the pure premium is only the saving part of the premium. This is the amount left after subtracting from the total premium all costs other than the payment of claims. Okay, it is what remains, and that will be kept as a reserve, as an insurance provision, okay, to pay claims in the future. Okay, so I'm going to focus on P0. The calculation of P0 is a key element, because after that you just need to add your estimate of the admin and distribution cost to obtain PT0. The tricky issue is to determine P0. So here you have a definition: P0 equal PT0 minus administration, commercial cost, and taxes. Well, so this graph represents the evolution of reserves over time. Okay, because when you collect the premiums, okay, part of these, P0, the pure premium, is accumulated. Okay, and P0 constitutes a kind of initial reserves the total amount of premium which is kept after the coverage of distribution and other costs, okay, which is kept for the payment of future claims. So on this graph, what do you see? You see the evolution of reserve, which is decreasing. Why is it decreasing? Just because day after day you are paying claims. Okay, so you have the claims payment, which explains why the evolution of reserves is declining. Okay. So now let's come back to the combined ratio to introduce this concept of time, and it is again useful to reconsider this ratio to have a clear understanding of the pricing. So let's assume the total premium are 1,000, admin and distribution costs 300. So the pure premium will be 700. Okay, the cost of claims would be, it's estimated at 770. So if you calculate a simple combined ratio as we did, we have 107. 107. Why? If you look at it, you collect a total premium of 1,000. The cost of claim is 770 plus 300, that is 1,070, okay, which is more than the whole cost, which are made of all cost, excuse me, 1070 is obviously higher than the total premium you have received to start with. Okay, so a combined ratio over 100% means that you have an underwriting result which is negative. We've seen that before. Okay, so the overall cost exceeds revenue by 7%. How can it be? Well, now if you look at time, if you introduce time in the system, okay, so you see on this graph that an evolution which is, as we've seen before, with the declining reserves due to the successive payments which are taking place. And this graph is built based on the data which are in the table below. So let's look at this table. In this table now, we are not just looking at the total amount of claims to be paid, but also when the claims are paid, okay? And here we are assuming a schedule for the claims payment. Altogether, if you add up all the numbers in the first line, you have 770, but you see that it's spread in different installments over 5 years. The first year you expect to pay 200 of claims, 250 for second year, 150 for year 4, 50 and 20. Altogether 770. Okay? And this is the red curve, which is indicated here on the graph. Now, if you look at reserves, okay, you start with 700 because you receive 1,000, but you have immediately 300 to pay, which are the admin and distribution costs. I have still assumed that all that was paid in the first place. In other words, what remains for the payment of claims is only 700, okay? So what is the reserve after 1 year? You have to pay 200, okay? But you also have a financial income, which is due to the fact that the 700 have been invested. Let's assume 5% as before. So it has generated a financial income of 35, which means that the reserves, which is available at the end of year 1, is 700, which we had before, minus 200 that has to be paid out, okay, plus the financial income that has been generated by the investment of the reserve. So that we end up with not 500, but 535, because the financial income has contributed to increase the reserves, okay? And then it's always the same principle. You have 350 to deduct from the reserves, but you also have to add to the reserves 5% applying to 535, and so on and so on. So you see that in the end, you realize that at the end, you still have a bit left, 725 of reserves, okay? Which means that altogether, the company will end up with a surplus. So even though the pure premium is lower than the expected cost of claims, of total claims, you see that if you take time into consideration, well, you see that there is enough reserve to cover all the claims, because over time, you have a financial income effect, which you need to take into consideration, which compensate for the initial deficit. Okay? So that if you look at the combined ratio, the simple combined ratio, to a certain extent, it's a nonsense if you have a financial approach to the insurance business. Why? Because you are comparing immediate flows, like the total premium you receive, with some costs which are going to occur in the future. So you need theoretically to look at present value rather than just taking the value that they are. If you have a pure accounting approach, which is what you find in the accounts of insurance companies, well, you can say the cost of claims is 770. But from a financial, if you have a financial approach, it's a nonsense because you are not paying immediately. So you should look at the discounted value of claims. Okay, so if you do so, if you look at the present value of claims payments, the discounted claim payments using still 5% as a discount rate, you would find a present value of claims payment of 694.32, okay? And the discounted combined ratio, looking at the cost of claims, okay, but the present value of it, plus the present value of admin and distribution costs over total premium, it would be 99.4%. It would be below 100, meaning that the company finally is making a profit. Okay? So you see, one ambiguity in the insurance accounting system is that it doesn't take really, it would be a bit different in life insurance, as we'll see. But in non-life, it doesn't take really count of time in the payment. Okay? So that from an accounting point of view, you have the impression that insurers have an underwriting loss. But in fact, if you look at present value, they don't have an underwriting loss if you take time into consideration. And if you look at present value of cost of claims rather than the just simple addition of all the claims paid over years. Okay? Well, but then you see that how it works. So you built a reserve to start with, and this reserve is used to pay claims over years. And this reserve invested generates a financial income, which contributes to the overall balance of the insurer. Okay? So, having said that now, let's come back to how to calculate P0, to insurance pricing, really. Taken into consideration time, because you have seen now that time cannot be taken out of the analysis to have a clear understanding and a complete understanding of insurance pricing. So for the sake of simplicity, rather than having a series of payments, we are going to assume, for the sake of simplicity again, that all the claims are paid later at a certain date D. And then the question is, what should be the net amount collected at the beginning of the period, that is P0, the pure premium, to provide the insurer with a cash value PD, in other words, a certain amount of money at date D, large enough to cover the cost of claim, assuming that insurance reserves are invested at RF. RF stands for the risk-free rate. So just a graph to summarize this problem. You have the time axis, okay? The period D is a time lag between the moment when the premium is received and when the claims are expected to be paid, okay? So you see, if you collect P0, P0 will be invested at the risk-free rate. so that at date D, you will have an amount equal to PD, which is P0 time 1 plus RF power D, which is the period of holding of the funds. Okay, and PD should be large enough, or you will calculate P0 to make sure that PD will be large enough to cover the cost of claims. So that's a problem. But you see, the problems come from the fact that you only have an estimate of the expected claims payment at date D. In real life, and you see how tricky the insurance business is, you don't know exactly what D will be. You don't know perfectly when you will have to pay in the future. And you don't know exactly, perfectly, how much you will have to pay. That's why insurance is a tricky business, okay? Because you need to calculate today an amount which you have to collect P0 with an uncertainty concerning when you will have to pay and how much you will have to pay, okay? So let's see how we can handle this, okay? Our problem is to determine what P0 should be. So now we need to have a kind of objective for the insurer in terms of risk management, okay? So we are going to assume that, let's assume that we launch a new branch of insurance with a specific entity to run this line of insurance. So let's consider the insurer has allocated an amount of capital, an amount of equity, if you like, S to this line of insurance, okay? So you have a certain amount of equity, which is a kind of safety net, for the insurance business. And the question is, what should be PD? In other words, the amount to be accumulated at the D to limit the risk of a loss higher than S to a probability alpha %. In other words, we're just saying here that the objective for the insurer is to reduce the probability. Let's say alpha % could be 1%, for instance. It's usually a low probability, okay? The insurer accepts the idea that he might lose money, okay? But he wants to limit the risk of such a loss, okay? So here, we are looking for an amount of money PD, which is be such that the risk to lose more than the equity which was injected in this line of business, the probability of that should not exceed alpha %. In other words, if you write it clearly with this inequality, the probability of XD, which is the total loss, which you have to pay at date D, minus PD, which is the amount you have accumulated. So if you have a difference there, it means that you have to pay more than what you have accumulated. Well, this XD minus PD represents the possible loss. That is the difference between what you have to pay and the amount of money you have. Well, and the probability of this loss to be higher than S should not be bigger than alpha %. Okay? So how are we going to solve that? Let's assume that based on historical data, what you have been able to calculate the expected value of the amount of loss to compensate for, the amount of claims. It will be E of XD. And you also have the standard deviation of the distribution of that, okay? Well, so here you see clearly what PD should be to comply with this inequality. You look at PD here. First of all, let's start with alpha %. Alpha % on the right side corresponds to the probability to have a loss which is higher than S, okay? Because if you have PD fixed here, you see the probability of XD minus PD to be higher than S is just alpha %, okay? So we have just a limit here. So on this graph, you find the value of PD which corresponds to the inequality you have here. If PD is as it is here, you can clearly verify on this graph that the probability of XD minus PD to be higher than S is just equal to alpha%. Okay? In other words, the conclusion in terms of pricing is that the price, the amount to be accumulated at date D should include a safety load. PD should be the expected value of the total amount of claims, okay, plus a safety load delta, okay? If you have this, then you can be sure that the probability of a loss higher than S will be lower than alpha%, okay? So this is a justification for a safety load. So now what should be P0? Here we have defined PD. So now what should be C0? We just need to come back to the present time. What you need to collect now to have PD after a period of D. P0 is the discounted value of PD at the risk-free rate. Why at the risk-free rate? Because PD already includes a safety load. So the risk is taken into account by adding a safety load. So when you discount, you will discount with the risk-free rate. Okay? So you have P0, which is equal to PD over 1 plus RF power D. Okay? Well, so now, if we take now the position of the policyholder, okay? If we take the position of the policyholder altogether, it's not just one, but because we look at a group of people, a group of risk, a certain size, okay? Altogether, policyholders will pay P0. Remember this concept of precautionary saving. P0 is the group precautionary saving. When I say group, I mean the group, the whole population of policyholders, okay? Altogether, they contribute for an amount which is P0, and this is their precautionary saving, the entrust the insurer with, okay? P0 is the amount invested with the insurer for an expected future payment of EXD. In other words, policyholders, they invest P0 and they expect in return the total amount of claims to be paid back, which is E of XD. Okay? So if you note U, the rate of return for the policyholder, then P0 will be 1 plus U power D, which is equal to E XD. If you take the position of the policyholder, they are investing their saving, their precautionary saving with the investor, and they can expect a return U, okay, which would be like this, okay? And since PD, I'm not going to demonstrate it, but we necessarily have a return U, which is lower than the risk-free rate, since PD is higher than E of XD. You could verify this, but you can believe me also, which will be simpler. But you could verify it by yourself very easily. But it's important to introduce this because you appear to be, to a certain extent, the return for policyholders. As I told you, even if it's not explicit, very few, when you buy an insurance for your car, you don't imagine that you have a return on your saving. First of all, you are not imagining that when you pay a premium, you are saving money. Because individually, it's a nonsense. You are not saving money, you spend money, okay? But if you have a collective approach, if you look at the policyholders as a group, they spend money in the first place and they get it back later on as claims payments. So you individually, maybe you will receive nothing. But if you look at the group of policyholders, if you have a collective approach rather than an individual, the group is getting the money back through the payment of claims. Okay? And what is expected in terms of return? E of XD. Since the policyholders altogether, they have paid P0 to start with. If they expect an expected amount of EXD at the end, well, it means that they have a certain return, which is U here. So U can be seen as a return for policyholders or can be seen as a cost of funds for insurers. The rate U can be seen as a return offered by the insurer as a remuneration for the precautionary saving invested by the policyholders. The rate U also represents the cost of insurance funds for the insurer. Okay? So if you look at fair pricing, and there are some papers, that's a bit of a theoretical approach, but I use it here for pedagogical reason because it's rather simple. Okay? So a fair pricing, you could use CAPM. I'm assuming that you are familiar with the capital asset pricing model with the famous beta. Because we could ask, what should be U? What should be the return for policyholders when they invest their money, their precautionary saving with the insurer? A fair return would be what? If you refer to the CAPM, it should be the risk-free rate plus a market risk premium times beta U. Beta being the systematic risk. Okay. Beta U is a concept which is called the underwriting systematic risk. And it is generally assumed to be negative because when you have more claims when the economy is not doing well. In other words, when the economy is not doing well, usually the cost of claims will increase. Okay? Because companies are not spending as much on safety. You have a business climate which is not that good, which is conducive to more accidents. Well, for many reasons. Well, I think it's kind of natural to understand this, but we observe it. Okay, so what does it mean? If when the market is not doing good, and the business in general is not doing well, if the cost of claims tend to increase in this case, it means that the cost of funds for the insurer will increase when the situation is not good. Okay, so the market, the underwriting systematic risk would be negative. The cost of fund will increase when the market is not doing well. If the return on the stock market is the index is kind of decreasing while the cost of claims is increasing, well, you have a negative beta. Okay. When things are doing better, when the market is doing better, when the business climate is better, companies tend to have less accidents. Okay, and people are usually more, let's say, in a better shape, with more optimistic attitude and so on, and we observe that there are less accidents. Okay, less companies. There is a good example on one specific line of insurance, which is credit insurance. You know, that's obviously true. When the economic situation is bad, the number of people going bankrupt, of companies going bankrupt, is increasing. When the economy is doing well, the number of, let's say, bankruptcies is decreasing. So you see, that is the perfect illustration of what I'm seeing here with a negative underwriting systematic risk. Okay? So if you have a negative value, it means that, for instance, if you have a risk-free rate of 4%, a market risk premium of 5%, and the beta, underwriting systematic beta, which is my underwriting systematic risk, which is negative, with minus 0.1, then you see that we should price with a U equal to 3.5%. That is slightly lower than the risk-free rate. Okay. So as a conclusion, the return implicitly offered to policyholders, included in the premium, would normally be lower than the risk-free rate because part of the risk transferred to the insurer is systematic and as such cannot be diversified away. Okay, so it's just that's a bit theoretical because there are some developments to try to apply this rule to insurance pricing, but it's difficult if you want to do it for each line of insurance because insurance policies are not traded, you know, and therefore we have no clear market indication to calculate the underwriting beta. But I think from a pedagogical point of view, it was interesting to look at this to understand what might have an influence on the pricing when you take time into consideration. And when you understand, it's also one way to illustrate and to insist on the fact that policyholders are not just paying a premium, they are altogether providing precautionary saving to the insurer, which is invested by their insurer. And they get a return on that implicitly in the pricing. And indeed, an important thing to consider also is that indeed, if you change the risk-free rate, would it decrease, for instance? Then you would decrease also. Interest rates and underwriting margins are interrelated, okay? Well, just to illustrate that again, it's still taken, this graph from the same report by Swiss Re, profitability in non-life insurance. What do you see here? You see the underwriting result for all the period, okay? For the US, these are for US insurance non-life companies. You see that the underwriting results are negative. You understand why now, okay? You understand just because it's natural, okay? Because the profit mostly come from the investment income, which is in yellow here. So you see the investment income is always large enough to generate an income that will compensate for the underwriting losses. And if you look at the return on equity, the return on equity is more or less always in the positive domain, just because the financial income are most of the time large enough to compensate for the underwriting losses. The underwriting losses corresponds to an implicit remuneration of policyholders who are paying a premium which is lower than the total cost of their claims, because it includes a remuneration of their saving. Okay? And what do you see also in this graph, if I still focus on this one, that you see the financial income is decreasing over time, which is due to the fact that interest rates have been moving down over this period of time in the US, okay? And because interest rates are moving down, and because, as we'll see, insurance companies have a lot of bonds, okay? Well, their financial income has decreased, and they had to price accordingly. In other words, you see that the underwriting loss is decreasing year after year, because, you know, the amount available to remunerate the precautionary saving of policyholders is decreasing because of lower interest rates. Okay? So it's clear, you see here a clear link between the interest rate and the underwriting losses. The lower the interest rate, the less there is to redistribute to policyholders, and the lower the underwriting losses. Okay? Which is also what you see here. You have the combined ratio, which is a blue curve. Okay? Which is increasing and then decreasing, but which is following the 10-year government bond yield, which is an expression of long-term interest rates, you see. The combined ratio is moving up when interest rates are moving up. It means that when insurers are increasing their financial income because interest rates are moving up, well, more of that financial income is redistributed to policyholders. Why does it happen? Because after all, insurers have no obligation to do so. Where the answer is clear: competition. You know, because it's a highly competitive market in the US. If US companies, insurance companies, are increasing their financial income, they have a capacity to be more, let's say, aggressive on the market and to lower their premiums, okay, to attract more customers, to be more competitive, and by doing so, they deteriorate their underwriting result. Okay, so it's because of competition that you have this link between the movements of interest rates, which has an impact on the return, the financial return of insurers, and the pricing. You have better price when interest rates are higher, and it's clearly appearing on that graph. Indeed, in countries where competition is not large, where you have a kind of oligopoly where few companies controlling the local market, you may not have this mechanism, and you can have underwriting profits as well as financial income, which is to a certain extent what used to be the case in a country like Japan. Well, here you have it again. It's again the same type of illustration. For the previous slide was for the US, but you see that if you look at it for a bundle of countries, Australia, Canada, France, Germany, Italy, Japan, UK, and the US, we would have the same observations. Okay. Well, so now to make sure you have a clear understanding of that, I think it's good to have an exercise. So normally I stop teaching, I stop talking, and I ask you to do that. Now, considering the way I'm teaching online, it's difficult to do so, and you are isolated, so it's difficult to have group work. So we are going to do it together. It's just an exercise to apply the methodology which I have presented as far as insurance pricing is concerned. Okay, so here we start with one simple exercise. The number of units insured is 10,000. So we look at a group of people, of individuals with the same risk, subscribing an insurance policy at the same date for the same period of time. Okay, this is what we call a generation of policies. Okay, so N is 10,000. The risk-free rate, let's take 5%. Claims payment delay 1 year. For the sake of simplicity, I take D equal 1. Administrative and commercial expenses, 30% of total premium, still with the same assumption, an immediate payment. So as soon as you collect the premium, you pay all these operating costs. So how to describe the unit loss? It could be an insurance for a housing unit, for instance. The total loss for each unit, that's a description of the unit risk. Either you have, let's say, an incident, and let's assume that all the house is destroyed, and it would cost 200,000 euros, let's say. The probability of that is 0.5%. And the other assumption is there is no loss. Okay, in this case, the loss would be 0. Okay. My question is the total premium of 1,500 per policy high enough if the insurer wants the probability of a loss over 1 million for this line of business to be at most 2%? Okay, so where you see, in this case, let's assume we are in a market where there is competition, and the insurer would be a price taker, as we say. So in other words, what I'm saying that if you enter a new market, well, you cannot just say, well, I'm going to fix my price like this. You will look at the market price. If you see that for this type of risk, the price on the market is 1,500, then the question is, can you do it with this price? So if you charge this price, the question is it enough? If you don't want to lose more than 1 million, okay, and the probability of losing more than 1 million should not exceed 2%. Let's assume this is our objective. And we are going to have another exercise, which I will comment after. So let's look at this first case. So the unit risk is what? 0.5% for a total loss of 200,000. So the expected loss per unit is 1,000. And the standard deviation, I'm assuming again that you know how to calculate a standard deviation, it would be 14,107. Okay, so based on the definition of the unit risk, you have the expected loss per unit and the standard deviation per unit, which is this. So what is the expected loss at T1? That is the expected amount to be paid in 1 year from now. Okay, because the claims payment takes place 1 year after you have collected the premium. It is indeed the expected loss per unit times the number of units, so 10 million. 10 million is the amount you expect to be paid in 1 year from now, if you decide to sell a policy to each of the member of the group. What about the standard deviation of the total loss? Okay. Assuming what we have done, we have a standard deviation for each unit, which is 14,107. So the standard deviation for the total loss would be n power 0.5 times the standard deviation of each unit, which is this. Here again, I'm assuming you understand this. Well, basically, it is included on the slides we have seen before when I have explained the law of large numbers. Okay, so I took the formula directly from there to calculate the standard deviation of the total loss. So in other words, we are facing a situation where the expected total loss would be 10 million, and the standard deviation of this expected total loss would be 1.411 million. Okay? So now what are we going to do? We are using the approach we have seen. Now, we've seen that if the law of large numbers applies, and it does apply here because we assume that all risks are independent, okay? All risks are independent, okay? And therefore, all the covariances are 0, and all the risks have exactly the same characteristic, okay? So in this case, if you have a normal distribution, first of all, let's look at alpha percent, which is 2% in our case. If you take 2%, the question is, what is the limit? Where is the limit that corresponds to 2% probability on the right of it? See? How to find it? If you have a normal distribution, you should know, you should remember here. Again, I have to assume that you have a basic knowledge in this field, but I know you had a course in this, that we can calculate the distance between the mean and the limit of 2%. If you take 2% on the right side or on the left side of the curve, you know that the distance corresponds to 2.05 times the standard deviation. Considering the standard deviation here, you see that it corresponds to 289, okay? In other words, the limit that corresponds to alpha percent, if you have an expected value of total loss, which is 10 million, if you had 289, you end up with 12,892 to be precise, okay? Well, so now that we have this limit, we have to consider the maximum loss that the insurer is ready to accept. This maximum loss, I call it S here. And S is equal to 1 million. Okay? So S is equal to 1 million, which is the maximum the insurer is accepting to pay with this probability of 2%. So we end up with P1, which should be 11,892. See, if you take P1 equal 11,892, let's assume that the insurer has this amount at date 1, then you can see that the probability to lose more than S is just alpha percent. So we comply with the objective. So our P1 is 11,892. Okay? So if we have P1, which is the amount that needs to be available after 1 year, the question is, how much do we need to collect today? We use the discounting technique, using 5%, which is the risk-free rate, okay? And we find 11,326, okay? So P0 is the discounted value at 5% of 11,892, okay? Over 105, we find 11,326, okay? So now, the question is, This is what we need, P0, to comply with our objectives. Now, what would be the premium income? The premium income, we've seen that on the market, the premium is 1,500. If you have n times this, because we have 10,000 units, we would collect altogether 15 million. Immediately, we would have expenses, which would be 30% of that. In other words, 4.5 million. What is left? The net premiums, deducting all the expenses, operating expenses, we have 10.5. What do we observe? That 10.5 is lower than 11,326, which means that our conclusion is 1,500 is not enough. Okay, 1,500 is not enough because if we collect 1,500 per premium, we end up with an amount of money today which is 10.5 available for investment, and 10.5 available for investment would not provide 11,892, which is the total amount necessary to comply with our rule. Okay, if you make a calculation, I didn't do it on the slide, but you can believe me, we could look for the amount of money that would be compatible with 11,892 after 1 year. You should find that you should have a premium of 1618 to start with to comply with the rule. Okay, so in this case, the insurer may not decide to enter the market because he would consider that the premium is too low to guarantee, it's too low to be compatible with his what we call risk appetite. Okay, so to make sure you have a good understanding, let's move to the other exercise. And I recommend that you do it yourself again to make sure you are comfortable with it. Now I ask you to determine the pure premium P0 to be collected so that the probability of an underwriting loss higher than 1,000 be limited to 1%. Number of unit 1,000. Total expected loss. Here I give you directly the total expected loss 10,000 with a standard deviation of 500. Risk-free rate 5%, claims payment delay 1 year. This exercise, maybe I should have started with this one because this one is even more simple. Okay, we come back to the same graph. Okay, in this case, the difference is that the probability is 1% rather than 2. So if we look at the limit for alpha percent equal 1%, we have to take 33 times the standard deviation. And we find a distance between the expected value and the limit for 1%, which is 1165. So in other words, if you have an expected loss of 10,000, okay, then you need to have an amount of money available after 1 year of 10,165 to comply with your safety rule. Okay, so now what should be the value to be collected today? About 968 per policy, because altogether you should collect 9,681. Okay, so if you do so, that's for the pure premium. What is the expected underwriting result for insurers? The insurers, they would collect this amount, P0, whereas their expected loss is 10,000. So you see they would have an underwriting loss of 329, but the amount they collect is invested at 5%. So they generate a profit, a financial return of 484. Okay, so that the net income in the end is 155. Okay, so this would be the pure premium pricing for the insurer in this case. Indeed, the total premium would be higher than this because you should have what is necessary to cover the operating expenses, distribution costs, and admin. Okay, so if you look at this, the implicit return for policyholders is what? You know, the policyholders, they pay altogether 9,681 in terms of saving. Indeed, they pay more because they have to cover the cost of operating expenses, but if you look at the saving part, they invest with the insurer 9,681, and how much can they expect? They can expect 10,000 in return altogether. Okay, altogether they pay 9,681, and they can expect 10,000 altogether in the end. Okay, so what is their implicit return? As you can see, it's the value of U, which is 3.3% here, which is lower than the risk-free rate as expected. Okay, so that's the basic techniques of insurance pricing. Now, I told you that real life was sometimes a bit trickier, okay, because there are some conditions which are sometimes difficult to handle. And here I'm assuming that I have all the data necessary for the pricing, but fortunately for insurers, it's not always the case. So let's look at the different practical issues that makes things a bit more complex than what I have described. First of all, you have the problem of low frequency and high severity risk. Implicitly, I have assumed in my examples some situation that would correspond, for instance, to the motor insurance industry. You have a large number of people buying insurance because there are many cars around. The risks are rather well known because you have a lot of historical data. You have good information to anticipate the evolution of the cost of claims as well as the frequency of it. Okay, what if you have to deal with risks which are hopefully very unlikely, okay, but when they occur, they are very severe, low frequency, high severity risk. Typically the case of natural catastrophe, pandemic, and things like that. Indeed, you know, the estimate of the expected loss is very difficult because the frequency is low, and low frequency, low probabilities are very difficult to handle. Okay, so all this calculation is very tricky. Okay, it means that we would have a situation, even if you have numbers, the numbers would not be quite reliable. There are numbers. If you take natural catastrophe, for instance, you have now some institutes who are specialized in evaluating the probabilities of earthquake, of storms, and all that. But you know, all that is not quite reliable because even in the case of natural catastrophe, you know, can you consider that historical data are reliable? Certainly not. If we talk of climate change, it means that the situation is changing and that the history does not provide you with reliable information to look at the future. Okay, that's the same for pandemia. Okay, we have a good case right now anyway. Okay, so data are not reliable and your statistics are not quite precise. So maybe we could use the same approach, but with a very large variance around the expected value. So if you have a very large variance, you see, you may have a safety load which becomes very high. And if the safety load is very high, it means that insurers would demand a huge premium that very few people would be ready to pay for. Okay, so hopefully, as we'll see, one solution is reinsurance. Okay, reinsurance will contribute to make it possible, at least to a certain extent, make it possible to find solutions for this low frequency, high severity risk. And reinsurance is the next chapter anyway. Another case is correlation. If you have correlation, the law of large numbers does not apply anymore. Maybe we can come back to the formula which we had before, which is there. So you remember that? Because of the absence of correlation, we could assume that all that was zero. Okay? All this block is zero if risks are independent. But if they are not independent anymore, this is not zero. And this is not zero, and then you can have a huge variance. And the huge variance would raise the same problem as what I have mentioned for the case of low frequency risk, high severity, because a large variance means that you have a huge safety load that might lead to a situation where the premium demanded by insurer would be much too high for people to accept it. Okay, so that's another difficulty. So the extreme case of correlation is indeed the case of a war, but you also have it to a certain extent for natural catastrophe. For natural catastrophe, you may have whole of a region destroyed, okay, with floods or big storms or whatever. So can you count on insurers to handle that? No, there are limits to what insurers can do. Again, here we'll see that reinsurance and particularly new type of instruments used by reinsurers may help, but there are limits. That's why for a natural catastrophe, when it becomes, when it have a strong impact, okay, on a large impact, because you have a correlation effect. You know, when you have a storm, it's not just one entity which is impacted, but a large number of entities within the group of insurers. Okay, in this case, the state would intervene. The state organizing a kind of solidarity. They may have part of it covered by insurers, but there is a limit to it. Okay, and over a certain threshold, well, the state will organize a kind of solidarity through by collecting from each individual a certain amount of fund to create a fund to cover the losses of natural catastrophe. Moral hazard. Well, moral hazard is also an issue, as I said. Insurers try to avoid it, but it's sometimes difficult to avoid. And that's why when they feel that there is a moral hazard risk, well, they like to create incentives, okay, and typically deductible, okay, and sanctions also, sanctioning severely those who are not sanctioning those who are not really following some rules, some safety rules. Okay, that's typically the case. For instance, I mentioned to you when we looked at the content of an insurance policy, there are some obligations in terms of prevention, and companies who would not spend on prevention just to save money, you know, by with the belief that insurers would pay in case of an accident. So why do we need to spend money for that? Okay, well, in this case, the insurer would include sanctions, possible sanctions, if the behavior was not a proper behavior as far as the risk is concerned. Okay, but that's concerns some risk more than others. Typically, for instance, it's a major issue for the cyber risk, because the cyber risk, you know, has a lot to do with how careful the company is with its IT system. Okay, and the insurers don't want to cover mismanagement. And that's a major problem for certain type of risk. Well, adverse selection and price discrimination. The problem here is to make sure that you are not attracting only bad customers. Okay, and the problem when you have a large group of policyholders, you have to assume homogeneity at a certain time, but you know that it's not purely homogeneous. You know that within the population, well, you have some. If you come back to the motor insurance, you have bad drivers and good drivers, and good drivers would normally deserve a better premium, a lower premium to pay, because they are less risky than the bad drivers. So that's why, you know, to avoid adverse selection, because if you are not able to discriminate, you will charge the same premium for everyone, which would be unfair for the good drivers. And the good drivers, they will feel it is unfair because what they pay is too high. And if you have competitors who are able to discriminate, the good drivers will move out and they will go where they are recognized as good drivers. So if the company is not able to discriminate, there is a risk that only the bad drivers remain with it, because for the bad drivers, the premium will be a good premium, okay? Because they know that they benefit from the transfer from good drivers to bad drivers, okay? So if you are not able to discriminate, well, you may end up with mostly bad drivers, and therefore you may have a level of loss which is higher than what you did expect in the first place, okay? Because you discourage the good drivers to buy insurance from you, whereas you don't discourage those who are bad drivers, okay? So that's why insurers are working hard toward an individualization of pricing. And they have improved a lot thanks to what? Thanks to big data, artificial intelligence, which might change the rules today. And this is the contribution of what we call InsurTech today. You know, there are lots of young companies, and I will provide you with some documents on this at the end of this course, because it's really a movement which we observe in insurance today. With InsurTech stands for the idea is that you integrate new technologies, typically IT, artificial intelligence, and all type of big data and deep learning and all these things, you know, into the insurance business, you know. And what can you do with that? What you can do is to discriminate, to recognize the good ones, the bad ones, and to have a very individual pricing. And that's why, you know, some people are claiming that it's the end of insurance, as I said already, because if you start to price each individual, you don't have this solidarity spirit that did exist at the beginning of insurance. Okay. Well, so there is a lot to expect from that. And I insist on this, and that's why I will give you some documents to work on that. Because in a country like yours, where, you know, you are in the early phase of the insurance development, I mean, I'm pretty sure that all insurance companies, all the new products will jump in this new trend, you know, of InsurTech, trying to see all the benefits and to grasp from the very beginning all the benefits you can get from these new technologies and the implementation of these technologies on the insurance market. Okay, so I have finished with this chapter. We still have 10 minutes today, and I will then introduce, I mean, the what comes next. Well, what comes next is here it is. You know, kind of solutions for the difficulties I have mentioned before. You know, I told you that there were difficulties for low frequency, severe risk, also for the effect of correlation and so on, which makes it difficult for insurance companies to price the risk. Well, as I told you also, well, they can go beyond what each company could do individually through reinsurance. So I'm going to explain what reinsurance is all about now, because it's a very important activity and quite interesting, by the way. And the difference between reinsurance, one of the major differences between reinsurance and direct insurance, as we call it, is that it's a global market. It's necessarily a global market because if you want to share the risk, large risk, you need to share. It's a system of sharing risk between companies, you know, rather than having one company bearing all the burden of the risk. Well, it's a way to redistribute the risk within a large group of participants in the insurance system. And this has to be at a global level. Okay? So the only thing I'll do today is to introduce the position of reinsurance in the system. So I'll come back to this representation, which I have used already, which we call the risk pyramid, okay, with the frequency on the horizontal axis and the severity on the vertical axis, showing that the peak risk are hopefully very severe, but not too frequent. So at the first level, if you take the position of a policy holder, of a person willing to buy insurance, okay, you have a risk exposure as an individual or as a company, and maybe there are some risks that you can retain. The risk fitting in your budget. You know, there are some small risk which you can afford by yourself. You don't need to buy insurance for that. For instance, if you are a company, for instance, you can say, well, if you are in the retail business, you know that some goods will be stolen by customers, you know, would just say, and they will get out of the retail outlet without paying and so on. So you know that this will generate some losses. This is a risk you have to face. But you don't need to buy insurance for that because you can be your self-insurer. I mean, you know roughly that it will represent maybe something like 2% of your sales. Okay, I'm not saying that you shouldn't do anything, but you can try to reduce it down to 1.5% of your sales, but you're not going to buy insurance for that, you know. You know it's part of your business and it would fit in your budget. In your budget, you will take into account the fact that you will have a loss corresponding to 2% of your sales year after year because of this people stealing in in your shelves. Okay. Well, it's only, but if you have a big explosion and a fire in your retail outlet with people dying, victims, and so on, that's another story. This cannot be in your budget. That would strongly disturb your business and your budget. So that's where you need. It's only when you move above a certain level of losses that you will think of insurance. Okay, so insurance is there to cover what we might call for the individual some destabilizing risk, something that would not, that cannot be taken, absorbed by your current budget. Okay, and it would, for a company, for instance, it would, in the end, have an impact on the capacity of the firm to reach its long-term objectives and sometimes to survive. Okay, so that's where insurance is needed. Well, but insurers have also a limit, because they have a limit to their capacity. Okay, they have a limit to their capacity because their capacity is linked to their level of equity, as we'll see later on. Okay, so based on their equity, well, there is a limit to the quantity of risk they can absorb and they can keep in their balance sheet. And sometimes it is difficult for them to say no to their clients. Okay, so they may accept the risk in the first place, but they know that they will have to transfer it one way or another to the reinsurance market. So the reinsurance can be seen as an insurance system, a global insurance system for insurers, so that insurers can transfer part of the risk they had accepted in the first place. Okay, so reinsurers can be seen as insurers for insurance companies. Okay, what you need to know also is that reinsurers, they also have their limit. For instance, if you take the case of the nuclear risk, or the risk in case of war, or for very severe natural catastrophe, the reinsurance system has also limits, because reinsurers, they also have a certain capacity to absorb risk, and there are limits to that. So there is a peak, which is a problem, where you need usually the intervention of the state. Okay. The problem today is for states as insurers of last resort. Okay. Let me give you an example, which is a bit tricky. You indeed remember the Twin Towers in New York when they fell together because of this terrorist attack. Well, immediately after that, all the aircraft was stuck on the airport in New York. Okay, they couldn't take off. Why? Because insurers said, well, considering what had occurred, now we have to revise our position. We cannot provide insurance anymore because we cannot cover against this type of risk. Okay, because the insurers have the right, to change the rule because they are never obliged to accept a risk. So after this incident, they totally changed their view of the risk of flying aircraft like this, and they say, no, indeed, a solution had to be found. And the Bush administration at that time said, okay, in this case, well, let's agree on a threshold. If this happens again, well, you will cover up to a certain amount. And above this amount, we would consider it is the state's responsibility. So the state would appear above a certain threshold, which corresponds to the limit that reinsurers have. The state would intervene as a kind of insurer of last resort. Okay, well, the problem today is that, you remember in the introduction, I have mentioned this evolution. You have an increase of peak risk due to the increase in natural catastrophe. Cyber risk is also a huge risk, terrorism, and so on. For all these reasons, you have a peak here which needs to be handled. So states can also intervene, but that's why reinsurance has also changed a lot with all types of new instruments which have been developed to try at least to improve the capacity of reinsurance to cope with this higher severity of peak risk. So I'm not looking at my watch. I'm not going to start today to get into the detail of what reinsurance is all about, how it works, how it is accounted for, and so on. Okay, this would be for the next session. Okay, but I just wanted to position today reinsurance as a solution for insurance, okay, when they have to deal with very severe situations, at the cases we have looked at before, when you have, particularly in the case of high severity, low frequency risk. Okay, so I will wish you a good dinner now, because I think it might be dinner time for you now. And I'll say you hello and see you tomorrow. Okay. So, and I hope you survive. And have a good dinner. I'm going to have a good lunch.
Thank you, Professor. See you tomorrow.
6 hours difference. Okay. So see you. Bye-bye.